let's pull up L&T. The company has posted the Q2 earnings last evening, have posted an 84% hike in profit, and the management has maintained the FY17 guidance, which is the most soothing takeaway. To help us to decode the earnings of the capital goods major, joining us on the show is Rohit Natarajan of IDBI Capital. Rohit, good to have you on the show. Let's start with the basic numbers itself. There's been a PAT increase, but of course, that's been helped by a 400 crore exceptional gain from the sale in the general insurance business. The other income is higher, interest cost is lower. Take us through what you make of this quarter's numbers, and do you see some up move from here on, at least in something like the infra segment?
What we have seen is that we forecasted better traction from the domestic part, but as you could make out, the domestic part has not contributed really well. Plus, it has largely been led by the international orders. But in our assessment of the domestic infrastructure projects, be it the pace of execution, the project completion, the shelving part, we see that there is a lot of progress made on the ground. However, L&T, it seems there's some sort of a project level idiosyncrasies, or the revenue recognition threshold may not have met. That could perhaps be the disappointment. But if you look at the construction company format as something like this, if revenue recognition is aggressive, it is starkly visible in terms of your working capital. But here is a case where Larsen has done a fantastic job in terms of the working capital reduction. So there is a cash flow from operation boost as well. So net, I would suggest that the company perhaps may be taking a conservative call. So the days could be brighter ahead.
Right. Rohit, tell us, going ahead from here on, in terms of the order book accretion, do you feel that the newer orders that are coming through have the ability to command greater margins or greater premium from these levels?
See, let me also tell you that the current order inflow was just up by 9% YOY of 311 billion, and they were largely led by the transportation, civil infrastructure, and other such orders. But margins, as we say, there's always it's anybody's guess, because it's more of an ex-post event. We could make a better guess, because from revenue recognition to the cash conversion, there are a lot of questions that lingers around. So the margins is of course a function of a lot of things, and we company being maintaining the margin guidance with a 50 basis point improvement in the core X services X IDPL. I think the orders should be of better margins.
Right. As you said, Rohit, there's been a problem in terms of movement on around 30 to 40 projects, and that comes from transport infrastructure, heavy civil, as well as certain of those categories, because of which the drag has gone on, the factory sub-segments as well. In terms of execution, do you think that there's a sluggishness and that can be expected to remain protracted into the second half as well?
See, what the management comment goes on over those 30 to 40 projects is something like this. They were just not able to meet the revenue recognition thresholds. So if that could be possible, you could have seen a very strong, robust pickup in the domestic part. And to our knowledge, as an industry perspective, what our ground feedback, what it clearly says is that the pace of action that is happening at the ground level is very strong. So perhaps in the quarters to come by, in Q3 or maybe in Q4, the revenue surprise can actually help the company attain its revenue guidance part.
So essentially what you're saying is that in the second half, there might be, a few, if not all of these 30 to 40 projects that will attain the revenue recognition threshold, and then the revenues for the infra segment and also the margins, incidentally, which this time have contracted 7.1 versus 9.3, may improve. So on net, by the end of the fiscal, they might return to parity or at least at a flattish performance on the margin front.
Let me just correct it. The margins, what they have said is that there will be a 50 basis point improvement over the base year. So we can expect a margin improvement. So will be an EBITDA surprise as well.
Okay. So that's about the infra segment. There's been a marked improvement in the hydrocarbon segment as well, as also the heavy engineering segment. The heavy engineering margins have swung back into positive at 14.6 versus a negative of 12.6, and the hydrocarbon EBITDA margin 7.1 versus 1.4%. Very sharp up move. Do you think there's a chance of plateauing out in terms of hydrocarbon margins? Because in terms of crude, we've seen an up move, but there's almost a ceiling or a cap at crude at around levels of $55 a barrel. Your view on both these segments, Rohit?
Let me talk on these two segments. These were essentially the laggards in the corresponding quarter last year. However, if you look at the heavy engineering segment, they are the PPN and D&A business. Led by that, the operating leverage has perhaps kicked into this particular segment, and that's the reason why we see 14.6% EBITDA margin in this particular heavy engineering segment. Now, if you look at the hydrocarbon segment, there were some legacy orders that has coming closer to an end, and also some claim settlement and operational improvement that is being talked about. So these things have led a turnaround in hydrocarbon, and going forward, I think this should be possible because they come usually in the cluster. So if you are doing a low margin work, it could spill over for a few more quarters. But having seen something radically different over the last 2 quarters, I think the trend will be positive in these two particular laggards, as been identified in the past.
Okay. What about the shipbuilding segment? Because the shipbuilding material and construction equipment segment has also witnessed a subdued performance margin contraction this time around. There have been inventory write-downs which have spoiled the show for that segment as well. What's the outlook from here on? Is this the bottoming out of that space?
No, that is anybody's guess as what the management commentary is, because the write-down part, they hope that this will come to an end, because we have seen this consecutively happening over the last 2 quarters, and that has been a drag over in the others segment. But if you look at this others segment EBIT part, it has been positive in comparison with loss in the corresponding quarter last year. Plus, you have a real estate component also involved into this other segment. So if let me just make a worst case scenario with all this demonetization front, if real estate part also remains a drag, perhaps other could get into that negative territory over the next quarter. But again, that's just a worst case scenario.
Okay, so also on a parting note, let's talk about valuations. I mean, I think the IDPL segment, I mean, in which they have, I think, 97 to 98% ownership, commands roughly around 75 to 76 rupees on the overall share price of L&T. Once that is hived off, do you see some bit of valuation upside associated to it in terms of the non-core businesses?
Let us just give a counterfactual scenario to this. If this comes in, you will have a finance cost reduction part. Plus, you will have, if this is being deployed back into the core business, which earns maybe better ROE in comparison with what IDPL does, yes, there is a very strong scope for a re-rating. But again, at what valuation would they sell it off, and the timelines involved in it. So there are a lot of ifs and buts that goes into it. So nevertheless, this is definitely a positive boost for the company if they can sell it off at the current valuations like what we talked about. Because to my knowledge, most of the analyst community that they have valued this company on par with the invested value. So essentially they are making a bet saying that the project IRR will be better than the equity IRR is matches with the cost of equity. But that may not be the case because most of the assets are not yet matured. So we don't know what valuations will the buyer will be willing to take up for this kind of assets.